All right, we are live. Welcome. I am Steve Papale, and it is Thursday afternoon, and today we're going to talk a little bit about how I sort of use the software a little bit in some of my trading. This is a little different, folks, than what I normally do. Let me do something here. Let me adjust my screen. Can everybody hear me okay? Because I always get weirded out about the audio on this, but hopefully you guys can all hear me. Good. All right, thanks, Roland. Okay, some people can't. Carl, it looks like I got audio across the map. Funny, Carl. All right, good one. I guess when you ask somebody if they can hear you and they answer no, there's something there. So, all right. Anyway, I'm going to do a little different tonight. I'm going to just kind of model out a trade or two, kind of how I use the software. I'm not going to get a whole bunch into the intricacies of the software. We've got webinars and all kinds of folks that are probably better at using all the parts of the software than I am. And there's tons of literature or tons of information out there and all that about all the facets of all the software. So I'm not really going to go there. What I will do is kind of go through a few trades, kind of just tell you the things that I look at just from my perspective. How I evaluate a trade, some of the Greek, some of the uses of some of the stuff in there, the strikes, and just from a practical perspective in terms of how I do it as a trader. So hopefully that'll be valuable for you. As always, jump into the chat bar. I see there's been a couple of questions already. So if you have any questions, just go ahead and enter them in there. Unfortunately, the way this is going to work is I am going to share my software, my OptionVue software here. So I'm going to be on that, seeing exactly what you're seeing. I will not be able to see any of the chats. So what I'll do is I'll spend 10 minutes going through a trade, maybe modeling it out. We'll play around with it, and then I'll jump back into the chat and I'll see if there's any questions, and we'll kind of go back and forth. So it probably won't take all that long, really. It doesn't take too long for me, really, to go through this. So, but I'm happy to answer any questions, and we'll take it from there. Here at OptionVue, we are full service option educators. So on that idea, I just want to remind everybody out there is only 12 days till Christmas. So please hurry and get your Christmas shopping in. I'm almost done, so I'm pretty happy about that, but pretty early this year. So let's get started. I'm working out of the house right now, so I got my son in the background. Told him not to yell, so hopefully he won't. All right, let me jump in. I've got a whole bunch of questions already, or appears to be, so I'm going to get onto some of these right now and see if I can answer a couple of these before I go into the software. Let's see, I trade covered calls, 80 stocks. Wow, okay. Does OptionVue portfolio just return the first two in the money? All right, the question is, this person, Ray, he does covered calls. Does OptionVue have a portfolio to just return the first two in the money and the first two out of the money premiums? I'm not sure I understand, Ray. Are you asking if we can go into the matrix and see what the extrinsic value is, or just the two strikes above and below the at the money? I'm not sure if that's what you're asking. Because that's where the return is going to be generated. That plus the distance between the strike and the at the money. That being said, there is a way to get the extrinsic value out there. Maybe that's not your question. Maybe I missed it. I'll toggle down here and see if that was it. All right, that might have been it. And are you going to go into your settings for slippage, volatility, model action? I'll go into some of that. I will show that, and I'll kind of play around with that, John. So I will go into some of the settings that I have set, and we'll take kind of a look at that. So, all right, I'm going to get rid of this ugly picture up here. This guy, I don't know who this guy is, but I'm going to call it. What I'll do is I'm going to share. I'm going to share my desktop here. So there we go. All right. Okay, so right now, everyone should see the software. Okay, you should be able to see my quote screen. Okay, the OptionVue quote screen should be there. I'm talking in the blind right now, so if you don't, I'm going to find out here in about 5 or 10 minutes. But everyone should see that. And you can see these are the numbers as of today. This is the close today. The Dow is down 104. And then I have some of the indexes, the mid-cap, the NDX, the OEX, SPX. I have the VIX here. You can see the VIX is up a little bit here. Of course, with the sell-off, you know, we're going to get that kind of move in the VIX. And we can see where it's kind of come in a little bit. It kind of popped up here a little bit over the last month or so. It was down here to about 12, and that looks to be the bottom. I look at this myself a little bit. I don't get married to this VIX too much, but I do kind of observe it. Just with, man, let me do this. Let me get over into the price chart. No, can't get rid of it. Just leave that then. These black lines are the price of the VIX, and you can kind of see it kind of swings up and down. The bottom is about 12. We've had some spikes when we had this issue, and I guess that was when the debt issue was happening back in October maybe. It spiked up, and then it spiked up last summer. But I kind of observe this a little bit. I don't, like I said, I don't get too worried about it. It does not really dictate too much my timing, really. I do observe the fact that we are in an upswing in the VIX. Vols are up. What this means for me as a position trader and as a manager is that, you know, even when the markets are behaving themselves in terms of pricing, which most of our strategies are right now, or one of them, we have covered calls on and we have a condor on. So we're right in the center with our condor, but we've been kind of losing some money. And the reason is because of volatility. We've had this thing on for, I don't know, 4 or 5 days now, and we've got the VIX has been up. So I can pretty much say that, you know, we're short Vega, we've got to move in the VIX, so that's probably cost us a little bit of profit here, unrealized, showing us unrealized loss. But so that's kind of how I look at VIX. It's still relatively low. We're looking at 15.5. You know, the E-mini, all this is no big deal here. These are just stocks, obviously. You could set this up any way you like. These are just things that I trade and look at. So I have this just set up for myself. So what I'll do is I'm going to go into the OEX. Generally for the option strategies that I trade, the non-directional stuff, I stick pretty much to the indexes. Okay, the SPX and the OEX are my preferred products. I choose them really. I used to be an SPX trader, so I'm familiar with that. Not that that really matters that much, but I like it. It's lots of liquidity. I seem to get filled pretty easy. The index itself, the volatility is a little bit less than the Russell. So that's kind of why the SPX. The OEX, a little more, you know, I didn't want to put everything in the SPX, basically. So I just trade the OEX. I seem to get pretty decent fills in there, too. So I sort of stick with it. There's plenty of liquidity in these indexes across all strikes. Okay, and we'll look at the open interest, too, and I'll kind of go through how I look at that. But you don't have to worry too much about these products in terms of liquidity, in terms of strike liquidity. When you're doing stocks, you do. It is kind of an issue when you're dealing with strike liquidity, especially the thinner traded stock. But with the indexes, it really doesn't matter that much. So these have plenty of liquidity, all of them, especially the SPX. But right now, we got the OEX, we're trading here around 792. So if I open up this matrix, what I did is I just sort of put in a butterfly, just kind of a, actually that was up a little bit. Let me reset this because this is all goofed up now. So here we got it. This is the matrix. December, 9 days to go. We're not going to do anything in there. We're going to look at January today, and then there's obviously February. I don't have any of the weeklies up here. I don't really deal too much with those, so I don't have them up. You can certainly do that. So the at the money in the OEX is 790. Okay. You may or may not, depending on your strategy, be concerned about this Volti number right here, because this Volti number will help establish, or will correctly establish, the standard deviation color scheme on the software. So the way you do that, or the way I do it, is I just simply look at this at the money volatility, this MIV. It's trading, call it 13. So I'll plug that 13 up here, and now you can see, I hope everyone can see this. It's really not very, the color is really bled out here, but the one standard deviation line here is right at the 830 level. So what that tells me is that this one standard deviation with a 13% volatility in January goes up to the 830 strike, or the 8/4 strike. Okay. That may or may not be useful, and based on how you set up your trade. Certain trades we look at things like that. Certain other trades we don't. Some people use it for setting, directional trades. Some technical traders use it. I use it sometimes, but I'll just point that out. That's what you do, or that's what you could do. So let's just say we're going to do a butterfly, and I'll just trade like a couple of butterflies here just for the heck of it. So we're going to do that, and then say, I don't know, I'm just going to kind of pick a strike. So we've got the 8/4, okay? I stuck to the at the money, okay? I'm going to treat this as a non-directional trade. So I'm going to just set this butterfly up, and I'm picking calls in case, obviously it's probably obvious, but I'm using the calls. For those of you that prefer the iron butterfly, you do it the same way. The only difference is instead of having the 4 calls here, you would have, 2 calls on, or 2 lot of the call, and then you would go down and sell a 2 lot on the 790 put. So you still have, you're still short 4 of the 790 strike. The only difference is now you've got 2 in the call, 2 in the put. Okay. This should be a 2 lot. And so I go up to the 825, and then I got the 790, so that's 35 points. So I just go down 35 points to make it equidistant. So that takes me down to the 755. So there's my butterfly. Okay. I've sort of set it up. I just kind of, it's preliminary. I just taken a look at it. The first couple things I'll do is I will look at this net requirement number. Okay. The reason that I do that is for a couple reasons. One, I want to know how much it's going to cost me. Okay, and it's going to cost me just under $3 grand. Okay, if I sell 2 of these and buy, 1 of these and buy 1 of these on that ratio. But if I do it twice, it's going to cost me $2,966. Okay. If for some reason, after you do these enough, you kind of get a sense for how much these cost. But if your strikes are off, the cost goes way up. So if I go like this and I'm no longer equidistant, my requirement went up, but I've got a margin. I got a gross margin requirement here. Because now I have an equidistant, so it's going to recognize this thing as a couple different spreads. But it calculates a cash flow, then a gross requirement. Net requirement barely went up. I don't know. I'm surprised. But generally, if you have a non-equal butterfly or an unbalanced butterfly, your margin requirement goes up quite a bit. This margin requirement went up $1,000. But the actual cost, overall cost of the trade, let me go down here and see if it works differently down here. Now, that one didn't actually anymore. I wonder if they didn't change the margin. Anyway, that's how I kind of do it. Generally, you get a little bit difference in terms of the cost of the trade. They may have adjusted the margin. I think Frank may have told me they may have changed the margin factors. That may be what's going on. But the point is that the first thing you do is you look at the cost, and this thing is going to cost us $29.66. Okay. Now, after I look at the cost, okay, I usually just kind of make sure I'm balanced. And I can see on this butterfly, you can see this is balanced. I can see my legs are even, so I'm just eyeballing it visually. I can see that I haven't made any, you know, addition or subtraction mistakes when I try to set my legs up. So you want to make sure that they're 35, one leg is 35 below the at the money, and one leg is 35 above the at the money, and that's what we have here. So we're balanced off. It looks nice. It's nice and symmetrical. Okay. Then I kind of go in and I just take a look here at the deltas, all the Greeks. So I'll look at delta. All right. It's very typical. We got a short delta. Okay. When we're doing butterflies and indexes, that's normal because of the vertical skew. Okay, we're going to get more of the short delta working here. The gamma's negative. Again, we expect that because we're dealing with an at the money, short 4 at the money, so that's going to give us our negative gamma. For those of you that trade butterflies, none of this is new. We're collecting theta, okay, again, because of the short 4 a lot at the money, and then we're short vega. Okay, so these are all normal. It all passes the smell test. So everything looks fine. So that's kind of how, you know, that's kind of what we look at. We go into the Analyze button. We kind of take a look at the break-evens. This thing is right here is kind of break-even. Right now, the way we have it set up, it's short delta, so it kind of peels off a little bit more as the market goes up. So you can see the slope is bigger here. And that's expected. And so that's fine. What I generally do at this point is I kind of take a comparison to the delta to the vega. And generally, okay, this is a kind of a rule that I use, is my delta, let me back up. Usually when I have the short vega trade, I like to lean a little short delta, offset the vega risk. And what I mean by that is if the market sells off, generally we expect the implied volatility to go up, like what we've seen over the last 2 or 3 days with the market sell-off. The vols have gone up. What that means for our short vega trade is we're going to lose money on the exposure to short vega. Okay? In this case, for every 1 point rise in implied volatility, we're going to lose $174 in unrealized profit. In order to offset some of that, we might lean a little bit short delta. Okay, so if we sell off, I'm going to lose on vega because I expect vols to go up, but I'm going to cushion that a little bit for a little while by having short delta. All right. The ratio is, there's no magic formula here as far as how much delta we want to lean short to vega. It's sort of a personal choice. I generally go about 10%. So if this vega is short 174, I might try to lean theoretically. If I could pin it exactly, I'd be short about 17 deltas. Okay, that's about 10% of my vega. Okay, that would be it. Now we're pretty close to there right now. I could play around with this and try to put an extra 1 lot in there. And you could see that that actually gets a little bit closer. And then you can see what that does to the curve here. It flattens it up a little bit more. So I've got a little more room up here on the rally. And if you compare that to the other curve, you can kind of see the difference there and just the shape of the T lines especially. Okay. So that's kind of the idea of the adjustment. Again, you got to kind of play with it because it's one of those deals where when you start adjusting one of the variables or one of the Greeks, you're adjusting all of them. So you can't just isolate delta and adjust that only, because when you buy an extra call, you're not only changing the delta, you're changing the gamma and the theta, which is not a big deal, but you're also changing the vega. So anyway, that's kind of what I do. I kind of go through that, and you know, that's it. So I'll say, okay, this trade looks pretty good. I would then go ahead and sort of figure out, you know, what's this trade, you know, what's this thing trading at? And then I'll kind of do the math on it, and I'll say, okay, well, we got 1390, and I'm working here live, so I'm going to do the math right here on the webinar. So I've got 1390 times 2, okay, minus 135, okay, minus in the money call, 41.2. So that thing's worth about 39 bucks is what I come up with for the fair value of this butterfly. Okay. The way I did that, again, I took 1390. We got 2 of those, so I multiply that by 2. That's our credit. And then we got one debit of 135. And we got another debit of 4120. Now that's 1475. I did the math wrong before. Let me do this one more time. 1390 times 2 minus 1.35 minus 4120. That looks better. Yeah, 1475. So the fair value of this butterfly is 1475. Okay, if I can buy this for 1475, that's essentially buying it for 0 slippage. Okay, when I buy it, this P&L, this gain-loss number, is going to come up about 0. Okay, there will be some commissions in there and stuff like that, but it'll effectively be 0. So then what I'll do is I'll go into my, you know, my execution platform, whatever it is, and I'll just model it out and I'll put it in there. As far as the process of putting a trade, you know, I'll look at the trade, and you'll get a market in the trade. And generally, if the midpoint of this butterfly is 1475, the market in the OEX for this butterfly is going to be something crazy like $10 at $18 or something crazy like that. Very wide market. Don't worry about it, because it's what we call a market off the naturals. All they're doing is they're taking the bid ask of every individual leg of the butterfly, so all 3 legs, and they're just taking the bid of one, the offer of the other, and the offer of the other. They're doing the math, and they're coming up with one side of the trade for that, and then they're flipping it over, and they're saying, okay, if we were to offer the butterfly, that means, you know, they're looking at the bid on the other, the offer, and the bid. So they're taking the width of the market, and they're mathematically calculating the value of the spread. It always comes up this monster-wide market. So don't let that concern you. That's pretty typical. And then you just kind of go in and you put your bid in. I never go in at midpoint. I always go in below market. You know, and then you kind of massage it a little bit. You know, we just let it go for a little while. Obviously, watch the market. If the market starts moving, your butterfly, you know, may adjust price, or you may even adjust strikes. So keep an eye on that stuff. Now, let me go through this a little bit. Some of these factors up here, and then what I'll do is I'll go back over to the chat area and I'll see if anybody has any questions or they want to model something else. These right here, this is the define, and we kind of have these little tabs here. I don't spend a whole lot of time in here. I sort of set this up ahead of time. You can see I don't have the leaps or the quarterlies or the weeklies clicked off. I don't really trade them, at least not in these products, so I don't include them. Obviously, all strikes or all intervals is what I have. I always set these strike ranges at large, and simply do that because that's what the that's what the developers told us to do in order to get the best sample size of strikes so we could have the best fitting curve. So that's what I do. It's set for large. I would suggest everybody do the same. You know, options, I mean, this is all standard stuff. You just add strikes, add months as needed. That's pretty standard, I guess. Modeling here, yeah, you know, these three models I don't worry too much about. You know, Black-Scholes was kind of the one that was around the floor, and each one of these has this little tweak on the Black-Scholes, I guess. I just have it for Yates. That's just what we have them sort of defaults at. They're all very similar in terms of theoretical option pricing thing. The thing that I think is important here is this part, this delta gamma. The true delta gamma is kind of important because what this will do is it will allow for the deltas to be a little more true in the sense that they're going to be reflective of the volatility effect at each individual strike. So it may not seem like a big deal, especially if you compare it to if you're using either Thinkorswim or Trade Monster, Option Express, or whoever. They may not be off a lot, but sometimes they can be off, you know, significantly, and I mean significantly, a couple of delta points. But to me, the way that we're trading right now, the most critical part of this isn't necessarily these MIVs or the theoretical value of the options or any of that kind of stuff. That's important, I guess, but for what we do, the real important thing is to get a real accurate view of delta. Delta really is going to be important. We try to pin delta as much as we can because that really is going to tell us a lot of how we do our adjusting and things like that. So anyway, I highly suggest True Delta Gamma. Click on that, units of currency. Skew curves, I don't get into, I don't use combined call put skew. We've had some conversations about this over the past. What this means is that if you go into the vol thing and look at these skews, you can see that the calls have different volatilities than the puts, okay? And the puts, generally the way that the volatility skew works is that you'll notice that the out of the money puts, the stuff below the at the money strike has higher volatility, and then as we start to rally in strikes, the vols go down. That's just you know, the way the option markets have been pricing those strikes since the crash of '87. Before '87 in the crash, everything was straight. I mean, these they didn't have this kind of vol skew. Okay, it was kind of a straight line vol curve. It was just everything just kind of traded at volatility. It's crazy. But now they have these skew curves. I find that it's a little better in terms of model fitting to the market if you don't, you know, combine these call and put skews, especially in the indexes. In the indexes, the difference between puts and calls can become significant. But let me point one thing out here, and this is what people sometimes get a little bit confusion. Keep in mind that theoretically, at any given strike, the call and the put at that strike are trading at the same volatility. Okay, at any given strike, the call and the put will trade at the same volatility. Now, there may be a difference that is there that has something to do with interest rate. Okay, but everything has to be lined up. Okay, otherwise there's arbitrage. And market makers or head traders, whoever, are going to come in and sell something expensive, buy something cheap at the same strike, create a synthetic future or a synthetic stock, and then they're going to turn around and lay it off in the future of the stock, and you can basically come up with a risk-free arbitrage. So just keep in mind that when you see a put and a call at one strike that is significantly different in terms of volatility, oftentimes that has to do with just the way that the pricing is in the market. If the deep in the money call, you know, it might be like a $30 call. Well, sometimes those calls are computer driven in the markets, and they just quote them really wide because that's how they do it until they're actually quoted by request. So anyway, I would say, you know, play around with this. I don't check it. I know Frank kind of tells everybody he doesn't do it. We've kind of agreed this is probably the best way to do it for us, and especially in the indexes. So that's that. And then slippage, I always set for mine for none. That's just how I do it. I mean, the slippage is the slippage. Once I put the trade on in live trading, it is, you know, my slippage is going to be reflected in my gain and loss. So I don't worry about this. Commissions included. Closing transaction, I don't do this. Entire position, I guess, if you want to just dump the position out. All this kind of stuff I really don't worry too much about. This gives a better market in the option price. And I'm not going to get too much into these other buttons. I don't really even ever go there. The rates are kind of set automatically, interest rates, especially in this environment. So they're pretty low. One thing I will, you know what, there are a couple other things I'll point out here, but I'm going to jump into back to the thing to see if anybody has any questions at all, and then I'm going to come back in here and point out a couple things that that we may want to consider when we're dealing with some of these indexes and stocks too. But let me just jump back and see maybe if anybody has any questions or any comments. All right, here we go. There's a few here. All right, EIEIO, yeah. Let's see. When you trade with theta decay trades, how do you hedge potential volatility losses? The question is, how do we hedge our losses when we're trading, you know, short or theta, short or long theta, typically short Vega stuff, like this butterfly. As I pointed out there, the easiest way to do it initially is to lean short delta. Okay, so again, if markets sell off and we've been short, and I'll show something that I have on right now real quick. We have a condor on. We've leaned short some deltas, and we're short Vega, and that acts as a little bit of a buffer against a sell-off. It doesn't protect you in case of catastrophe, obviously, because it's a short gamma trade, and so every time the market goes down, okay, our short deltas are getting less and less, and we're going to end up flip-flopping and becoming long deltas. So that delta protection only helps us a little bit, but it helps us, you know, it's a little bit. It's better than nothing. And on the flip side, obviously, if markets rally, then we're going to lose a little bit more on those short deltas, but we expect vols to kind of come down on rallies. So that's kind of the way that I hedge it. You know, by buying extra options as a way to flatten those deltas is another way. So you're going to be buying in a little bit more Vega, so that's a help too. But that's something that's something we have to live with. It's part of, you know, we don't want to buy too much Vega back because we're going to end up losing theta. We're not going to make any time decay. So, can you comment on the vol model EIEO stands for every individual option implied it has its own implied volatility. Okay, and what that means is that the model basically goes through and sets every option strike its own volatility based on the MIV volatility in the market. And so you can get a little more of a bumpy curve along there. And that's really what it means, as opposed to like the variable, which kind of fits a smoother curve along the range of strikes. I happen to use EIEO. I only have been using it for a little while, actually, a few months. We found that it seemed to fit a little bit better with some of the multi-legged strategies and some of these indexes. We've seen that it fit itself better. But again, the model does a pretty good job of fitting curves. It does a good job of throwing out some of these crazy outlying options, like way out of the money options that can really goof up a model sometimes. The stuff that trades under 50 cents, you have to kind of throw all that stuff away, because even 50 cents, maybe like 30 cents, because any price changes in that stuff can really jack your volatility. So if my option's trading at 30 cents, okay, and it's measured at a 20 volatility, if suddenly that option, the market in that option trades at 40 cents, okay, say the market's 30-40 and it's priced at 30, if a 40-cent trade goes up, that price of that option just went up by like, 25 or 30% or whatever that change is. Well, that's going to change the MIV from, say, 20% to like 40% or 30% or whatever. So those cheap priced options can really throw off your vol curve. So anyway, the model sort of takes care of all that stuff. So to answer your question, I do use ZIO. Yes, I'm going to bring the screen back, and we'll talk about a couple of other things. I want to show some things about open interest too that we can share, because there's been some talk about open interest. This is always something. Can you show us how you manage a vertical call or vertical put spread? I'll model out a vertical call or vertical put spread, Marcos. I'll do that next, and we'll just kind of play around with that. So, all right, let me go back and share my desktop. So I'm going to go back here, and here we go. We're back in the thing here. The last couple things here I want to just go into here, and I'll show this in the OEX too, because in the OEX you really got something here that you got to be aware of. I mean the SPX is, look at, you can see the open interest and the volume in here across strikes, pretty good. But you feel sort of tail off here as we kind of get away from the at-the-money strikes. You can see the volume is all pretty good in the OEX. This is, again, like I said, with the indexes, this isn't a huge deal. There's pretty good liquidity across most strikes, especially in these front months. There's not a whole bunch of open interest here, and in these you can see, and the volume has been light. The OEX used to be this used to be the biggest traded product out there, I think. But in the last about 10 years or so, it kind of fell off. I think a big part of it is that the American exercise, people don't like that, and especially fund guys and hedge fund guys, and they don't like to worry about getting assigned. So I think the world sort of gravitated towards the SPX, which is European, especially after probably, when the market sold off in the early 2000s, because the public kind of got burned. And I think they just bailed out, and they were a big user of the OEX. The public, the retail trader, loved the OEX, the American option. But when the retail, the public left, that product sort of went away, at least relatively speaking. And so now you have the SPX. Now, let me bring this up real quick. What I want to point out with the SPX, I'm going to bring up volume, and I'm going to bring up open interest. And the SPX is obviously a product that's got a lot of liquidity and a lot of volume that trades. You can see this thing's got 58,000, okay, open interest on these 1,600 puts. Now, what I want to just mention here is don't get too hung up on like all the strikes and where all the liquidity is. Like, wow, this thing's got 60,000 open interest. I'm going to trade that because I'm going to get really tight markets. You won't. You'll get the same market at this strike as you will at the 1605 or pretty much across the board. Okay, you might get slightly more, maybe, but doubtful. Because there's these trades you can kind of do a little diagnostic on that. And this trade right here, if I go down here, I can probably find another trade, hopefully, there's a 1625, 1600. Now let's go to the calls and see if we got a similar volume. I haven't done this. I didn't check this ahead of time, so I don't know what I'm going to see. Hopefully I'll see a decent sized number on the call end. and then I'll tell you why I'm doing this. And okay, 11,000. That's not that much on the 16 quarters. And the 1600s has got 18,000. Well, you got 11,000, 18,000, 45,000, 58,000. Okay. What I'm trying to point out here is this thing. When you see these kind of big volume numbers, kind of pair them off a little bit, okay, and say, okay, wow, look, there's a whole bunch at the 1600 put strike. What's at the 1600 call strike? Generally, what we'll find is you'll find these big numbers at these strikes. What that means is it's something called a box. I'm not going to get into much what a box is, but it's an institutional trade that these firms come in and trade in order to borrow money. Okay, it's a pure interest rate play. So you're going to put up these big old numbers, and that doesn't necessarily mean there's going to be a whole bunch more liquidity at these strikes, because as far as the market makers are concerned and the firms, these are just on the books, but they're matched up. The trades are matched up, and they're just going to sit there until January expiration or close thereof. So kind of keep that in mind when you see these open interest numbers, because people get all hung up on these quarter strikes, and the reason that these quarter strikes show up is because the firms like to do boxes at these strikes, which is how they do them. We used to trade a bunch of these back when I was a market maker in there, and that was, you know, we'd put up, this is exactly how it worked. I don't see as many here, but there, you see there's probably, these are boxes. So don't worry, you're going to get tight markets. People that are short, you know, if these are outrights, people are happy to buy options right next to the strike if they're short a strike, almost as much as they will at that strike. So so anyway, that was kind of what I, you know, wanted to point out with the open interest. So anyway, this is you got to look in the equities. It becomes more of an issue, I think, because you've got pin risk, you've got dividend plays, you've got, you know, stuff like that. So you really do need to look at the open interest in the equities, almost strike by strike in some cases. All right, now let me go back to the OEX and let's play around with a vertical here real quick, and then we'll take a few more questions. And I'll be around here for a while, so I'm happy to hang. I'm not going out. It's like 10 degrees outside here in Chicago. Although my son wants to go ice skating, we have an outdoor rink here. And I went the other night, and it was like 5 degrees. Let me tell you, I was there for about a half hour, and then I went in the warming house. Let me go back to and reset this thing. Okay. And again, you guys know these tabs. You can set these and format them any way you like. This is just how I have mine. I like to see the market price. I like to see the vols. There's obviously a trade, the existing position. I always like to see the original price just to see what, compare it, whatever, and then the delta is important too. But you can customize this any way you like. If we were to do a, let's see, let's do a, we do call spread. Let's see, 792. Let's take just a, you know, a little call spread here, a debit call spread. So if I were to buy 5 of these and let's sell 5 of these, okay? So there's a debit call spread, okay, in the OEX, a bull call spread, okay? Again, here's the price. So you got, you know, you got an $8.40 and a $3. That's $5.40 times 5 is roughly $2,600 bucks, and there you have $26.95. So you know, smell test works. The price looks reasonable. It's a bull call spread. It's a debit spread. There's our debit. There's our delta long. Okay. We just happen to pick these strikes. Obviously, this delta is just a function of the strike selection I picked. I just picked these out of the air, basically. It's got a little gamma, long gamma. Again, we expect that. Why do we expect it? We expect it because our long, or the strike, let me reset. The option that's closest to the at the money is going to have the biggest impact on gamma. So the at the money is these around the 790, right between the 90 and the 95. So we're long the closer strike is 800. So we're long those, so that's going to have the long, it's going to have a bigger gamma than the short. And we can show that right here. That's gamma is 127, and that gamma is 104. So overall, we're long a little bit of gamma. We're paying out theta. Again, this long option, closer to at the money, bigger theta. There you have it. Okay. And it's long vega. Yeah, same concept. So, you know, we'll kind of look at this, and I'm just going to make a note here. There was somebody that asked me about extrinsic value, I think, on covered calls. I'm going to do a couple things with that when I'm done here real quick. And there's our model. So you can see this is the at the money right here. If the market goes up, obviously we're going to make money. Okay, we break even right here. This is our break even point at expiration. Okay, so that's going to be to how far this market has to rally. We paid about, what did we pay for this thing? We paid like $843. So we paid like $540 for it. So it has to go about $540 above the 800 strike. So a little bit above 805, I guess, is where it's got to go, and that's right here. So you can see that's the break even right there. And then obviously we're capped. You know, we're capped. So the most we can make, this is a it's a $15 spread. We paid roughly 5.5 for it. So the most we can make is $9.50 5 times. I'm just doing this math. So 45, a little more than 4,500 bucks, 46 or something, 47. And then the most we can lose again is that debit, or that $2,600 or $2,700 or whatever we're paying for it. That's the most we can lose. So you can just kind of see how this flows through. Typical analyzed graph for a bull call spread, and you know that's pretty much, you know, that's pretty much what I look at. I don't trade a whole lot of directional stuff, so but we have plenty of folks that do. So this is modeling these things out is the same. You just kind of look at the cost. At least I do. I look at the Greeks. I model it out. I look at it. I might look at that. I look, you know, and I'll just eyeball it, and I don't spend, you know, a ridiculous amount of time, you know, studying every little nuance on it. I'll look at it, and eventually, these things start to kind of look alike after a while. I mean, you can kind of eyeball them real quick the more you do. So that's that. I'm going to go back and I'm going to answer more questions. But I wanted to go in here and just, I know somebody had asked about covered call, and I happen to do I do a lot of that myself. And I don't use this feature that much, but there is a thing here called time premium. And for example, in fact, let's go to a stock and do this, make it more realistic. Let's go over to, let's go to Apple. There's a good one. So you got Apple, and Apple, I got the weeklies on. All right. So we'll move over here. Oh, God, look at Apple, all the stuff they got. Let's just go over and use this one. But you can go over to this time premium, and you know, we got the 560s. This thing gives us 985 a time premium. Okay. Obviously, there's 54 cents of intrinsic value. The stock traded at 560.54. If the price is 1040, okay, 54 cents of that is intrinsic value. So 1040 minus 54 cents is 985. So, you know, so if I were to write a call here, you know, against stock, I'm not, you know, you would put something like this, and then you have, that's not right. It doesn't look right. Let's do this. It's here. Why is it? Oh, why? I got a bunch of stuff in here, obviously. Hold on. Clear all trades. All right, let's try it again. There, that's better. I had some stuff in there. I don't know where that all came from. But here you have a nice little thing because you can, I think you're asking about the total return maybe of a trade. And here it is. This is on the parity graph. You can certainly add the T lines into it over time and see how that behaves. But you can see how this return is going to behave. So I'm going to make, if this thing goes up above my short strike or my 560 in this particular weekly or whatever, I'm going to make like 4%. Okay? And, you know, so there you go. You can just model this thing out. And then you can pick this one. If you want to go, you know, a couple of strikes below, you know, you could just keep remodeling it. And then you could compare and superimpose them and stuff. Whoop, superimpose them. So that's kind of a slick thing, I guess. If you're doing lock cover calls, you'd be able to look at a total return number and a yield number and do that. All right, let me go back to the questions and see what we have here. Hopefully that was clear. All right. We got my son in the background here doing his homework, just like his dad. Okay, let me see. Okay, why would your vol be 10.4 and mine is different, 8.7 in the matrix next to you? Okay, which vol was 10? Roger, which vol were you talking about that was 10.4? They should be, it could be slippage. The only thing I'm wondering is if you have some slippage effect, because the MIVs should be, there shouldn't be a reason why your MIVs are way off. Oh, and the OEX. Let me go back to the OEX and find out what you're talking about there. We're going to have to just, let's see. Let me see. You're talking about 790. Now. Oh, you know why? This wasn't 10.4. This defaults to 10.4. Roger. I think I went out here before to the Jan, and I think this was like 12.9, so I believe I set it for 13. Okay, yours should be close to 13 because that MIV is taken off of this. There's a bid ask, okay, and it's run through, it's just pushed through a model. It's calculated. No matter what model these guys are using, whether it's Black-Scholes or Koch-Rubinstein or Yates or you know, something off the internet, it doesn't matter. They're all coming in pretty close. Option pricing models are pretty efficient nowadays. Nobody's going to come up with some magical price that's way out. So you should be there. The only thing I'm thinking is you could have your slippage set. I have mine for none. I'm not sure if that affects it or not, though, but they should be pretty much the same, I would think. But that 10.4, getting back real quick, Roger, that 10.4 number, sometimes the software just defaults back to some random number. I don't even know what that 10.4 means, but just know when you set up your trade and you want to look at standard deviation, make sure you put in the real one. Okay, mine goes to 10.4. 10.4 is nonsense. Yours goes to 8.7. 8.7 is obviously not right either. Just make sure you plug in the new one. They all the software it never sticks. So, do you sell vertical credit spreads and how do you manage it? I sell vertical credit spreads as part of Condors. You saw that Condor we had on just a minute ago. Generally, we trade fairly non-directionally when we do these option types trades that we teach in the program. We do a lot of call writing, a lot of put selling, stuff like that for portfolios, but we don't trade a whole lot of directional stuff using verticals outside of the vertical as part of a more complex spread like a butterfly or a condor or something like that. Let's see. Good question though. Good questions. Do you model the horizontal skew now that we have that capability? I don't, Lewis. The only reason is because I don't really trade horizontal. Everything that we do that's a calendar or a diagonal is on a portfolio of stock. So what we're doing is rolling calls or puts, and the entire trade there is based on yield. So we're not trying to model a calendar necessarily or fit a calendar. We're just simply buying a call back and selling a different call and trying to determine a yield or closing a trade or doing something like that. So it's all based on the pricing in the market. So I don't do it, but I know that's been a real upgraded feature in the software. All right. My SV, my standard statistical volatility in the OAX matrix reads 15.5, and the chart it reads 8.5. I refresh the chart data, no change. Anytime we have 10.4 for the statistical. What chart, Kevin, are you talking about, if I can ask? The SV, I believe, in the software is about a 3-day. Is it a 3-day average? I think. No, it's a 1-day average in OptionVue. The chart in OptionVue. I don't know why they would be different. I don't offhand know why the unless the one of them was lagging in the matrix, unless we have statistical volatility in the matrix that's lagging. I think it's an average over a few days. That may be why. I know in the OEX, if we look at the statistical volatility in the matrix in the OEX, it's much lower than the IV. Because I don't believe that it's all caught up yet. All with the moves we have in the last 3 days. I'll double check on that. I'm not exactly sure why that necessarily would be though. Obviously, I don't look too much at statistical other than, you know, when we trade this stuff, we recognize sometimes that some of these indexes are chronically overvalued. But I don't spend an awful lot of time focused on that. But we do have guys that do. It's just, you know, I don't look at it. But I'll make a note. That's a good question. I never noticed that before, to be honest with you. So I'll try to find that out for you. I don't know how to get a hold of you, but I'll talk to Jim because I think he's got everybody's email on here. So maybe we'll put something out or something. Your SPX matches. I wonder why. That may just be data. I don't know. I don't know. I always blame, whenever I get an issue that I can't quite explain with something like that, I just blame it on data. It's like, just data. I don't know. And I'm surprised, it surprised me a little bit. SPX can be notorious for having goofy data too. Both products, especially the SPX, is it's a pit traded product still. It's not electronic, so sometimes I think that delays in some of the data. But anyway, that's a good question. I'll have to ask Jim about that or Jeremy. All right, guys. Well, listen. It's been my pleasure to be here tonight. I appreciate everybody coming. I know how busy everybody is. Everybody, if you traded today, or sometimes people are a little tired after the market close, and especially after the 3 days we've had here, all this excitement. But I really appreciate everybody being here. I wish you all a happy, healthy Christmas season. Don't forget to get you only got 12 more days, so get on that. If there's anybody has any suggestions for future webinars, please email me or Jim or whatever. We'd love to provide what the interest level is. Okay, I do a fair amount of these things, and I love to be able to give everybody what they're interested in. So anyway, thanks for being here, everybody. Have a great night. Take care.